Incorporating free cash flow yield in dividend analysis. Dividends. A potential source of income and hedge against market volatility. The importance of dividend investing is a widely studied topic by academics and market participants alike. Our own research has shown that dividends are a key contributor to equity returns. Nearly half of the total return of the S&P 500 came from the reinvestment of dividends and the effect of compounding over the 28-year period ending December 2016. From 1928 to 2016, dividend income return contributed 43% of the monthly total return of the S&P 500. According to a study done by Robert Arnott, for over 200 years, ending in 2002, the U.S. stock market generated an average 7.9% total return on an annualized basis, with dividend reinvestment contributing 5% per year. In addition to contributing to total return, dividends can also act as a cushion in down markets. Numerous studies have demonstrated that dividend-paying companies have historically exhibited less relative downside risk and take less time to regain losses, therefore delivering higher risk-adjusted returns over the long-term investment horizon. With high free cash flow possibly indicating a strong, healthy balance sheet, we tested to see if free cash flow yield, defined here as annual free cash flow per share divided by stock price, contains any meaningful return information. Our investment thesis is that all else being equal, a company with a higher free cash flow yield will deliver higher free cash income for each US dollar invested and is preferable to one with a lower free cash flow yield. Exhibit 9 shows the returns of ranked quintile portfolios by multi-factor value. We can see that returns predicted by the integrated value are consistent with the performance indicated by dividend yield and free cash flow yield when used separately. It comes as no surprise that the combined Quintile 1 portfolio, which also had the highest excess returns, outperformed the broader market by an average of 6.03% per year, compared with annualized excess returns of 0.10% and 3.57% from the first quintile portfolios ranked by pure dividend yield and free cash flow yield, respectively. Incorporating cash flow yield into dividend portfolios does not result in lower yield. The Quintile 1 portfolio also had the highest dividend yield, see Exhibit 10, with an average annual yield of 3.8% during the period. This high dividend yield is supported by an average free cash flow yield of 12.9% for the quintile, compared with the overall universe average free cash flow yield of 7.1%. Conclusion. Dividend investing is an important part of total return generation over the long-term investment horizon. Our research shows that dividend-paying stocks have historically outperformed non-dividend payers. Moreover, the top quintile portfolio ranked by dividend yield had higher risk-adjusted returns than the bottom quintile portfolio. When choosing high dividend yield stocks, the sustainability and quality of dividends should not be overlooked. We found that a portfolio of companies with high free cash flow yield outperformed the overall market and companies with low free cash flow yield. For market participants seeking solid and durable dividend income, combining free cash flow yield with dividend strategies can serve as a starting point. Our study showed that a hypothetical portfolio constructed by incorporating free cash flow yield and dividend yield metrics historically displayed higher risk-adjusted returns than pure dividend yield or free cash flow yield portfolios without sacrificing income.